Welcome all, and thank you for joining the latest Urban Living News webinar, where today we are going to be focusing on investor sentiment, specifically in the US and Europe, across hospitality and living. So my name's Eloise Hanson. I am the editor of Boutique Hotel News, and you would have seen from the introduction that was playing there that BHN is the sister brand to Urban Living News, and collectively we are part of the international hospitality media portfolio. Some webinar guidelines before we kick off. We're going to spend around 45 minutes in discussion today, followed by some time at the end to take any questions from the floor. So calling on our audience members now, if you do have any questions, please submit these using the Q&A function. I'll keep my beady eyes on it and I will ask those questions as and when I can. And as a reminder, this webinar is being recorded and this replay will be sent out to everybody within a few days. So let's meet our panel today, and I'm going to move from left to right as per your screens and ask each to introduce themselves briefly. So Joe, I'm coming to you first. Over to you.
Thank you. Pleased to be part of this webinar. Joe Stather. So I am the Vice President and Market Leader of the Operational Real Estate team at Questex. Many people, I'm sure, will know Questex as the company that runs the International Hospitality Investment Forum, or IHIF, the annual hotel conference in the UK, and the Resort and Residential Investment Forum, which this year will be in Lisbon. And we also have a hospitality investment online editorial platform called Hospitality Investor, very aptly.
Thank you so much, Joe. And coming to you next, please, Rachel.
Yeah, thank you for having me. I'm Rachel Rothman. I head up the hotels research team here at CB. I lead a team of about 25 dedicated professionals focused solely on hospitality. We span every country that you can think of. I think 110,000 people work here, and I'm desperately awaiting an invitation to Joe's conference in Portugal.
Nicely teed up there. Well done, Rachel. And coming to you next, Love.
Firstly, I guess I've aged a lot since the picture you have on the screen, so probably I should give you a newer picture. But I have two companies, Best Star Real Estate here in London, which is a mixed-use investor developer focused on Greater London, and we're active in hospitality, currently for sale housing and office, and our affiliate in the US, Best Hospitality, is an owner operator of hotel assets in the Mid-Atlantic, Texas, and New York City, and also has grown into retail industrial.
Thank you so much, Love. And I'll flag here that the LinkedIn profiles of our speakers today have been popped into the chat, and they're there because we're encouraging you to connect and carry on that conversation long after this webinar has finished. So before we get into our main meat, I suppose, of the conversation, I'd like to flag some stories that we have been published on Urban Living News, which will provide some context for the discussion today. And the first, which is on the left-hand side of your screens, reveals how the student housing market in the US is outperforming other real estate verticals. Now, according to Yari Matrix, rents have increased by 7% year over year to a record high of an average $829 per bedroom. And strong demand is also leading to faster pre-leasing rates. But however, despite this, investment has surprisingly slowed down. $148 million in sales were completed in Q1 of this year, a major decline from the $1.5 billion in sales recorded in Q1 2022. Also on your screens here, over in Europe, an Italian university in Sicily has bought the Hotel Riviera to transform it into student housing, and 65% of the deal was funded by Italy's share of the European Union's €672.5 billion COVID Recovery Fund. And other notable acquisitions of late include Greystyle's JV to purchase over 2,400 rental housing units in Spain, and data from BNP Paribas reveals that build-to-rent investments in the UK exceeded 1.1 billion in the first quarter of this year. And that last story there also highlights some notable acquisitions in the build-to-rent sector if you would like to learn more. On the next slide, I would like to focus on co-living. The Miami City Commission is considering changes to its zoning code to allow co-living developments in certain parts of the city, and this is to help provide affordable rental accommodation. And with new potential developments comes the opportunity for new brands to emerge. And just last week, Eurofund Company has launched its first co-living concept called Tribute in Southwest London. And to round off this part of the webinar, I would like to close off with hotels. Now, Placemaker, which we branded from Y Hotel due to the rise in demand for flexible living options after the pandemic, has recently raised $65 million and appointed the former president of Graduate Hotels as its chief development officer. And PPHE Hotel Group is also exploring new asset classes, having secured planning permission in Park Royal in London for a site that includes co-working and office space, as well as potential co-living amongst other uses. So I hope that has given you some flavour of what we're going to be talking about today. So let's kick off, and I'd like to come to Joe for my first question, please. I saw the press release about Questex's Hospitality Investor Sentiment Index, and I'm wondering, Joe, if you could please provide some key takeaways from that survey, and also which asset classes are proving attractive for investment.
Sure. So this is a survey that we conduct every quarter, and we poll our investor council at Questex, which is I suppose a community of leading investors, fund managers, principals, and we ask them a series of questions around predominantly hospitality investment to get their thoughts on where they see the industry going over the course of the next 12 months. We get a really good response rate. As you know, we work with a lot of investors across our events, so they're a very engaged community. We also have quarterly meetings around the investor sentiment survey as well, where we bring the investors together under Chatham House rules, and we discuss the results of the survey, which is always a pretty dynamic and lively conversation, shall we say. So we've just had the Q2 results that have come in, and the findings are pretty interesting, I think. First of all, starting at a kind of consumer demand level, broadly speaking, in terms of short-term accommodation demand, investors are pretty buoyant, certainly in regards to where opinions were in the last few quarters. Clearly, there was a lot of macroeconomic volatility coming out of 2022 and into 2023, and that was really rattling investor sentiment around consumer demand. You know, leisure demand we saw come through really strongly out of the pandemic. It really did lead the way in terms of delivering good accommodation demand growth for hotels. But inevitably, with the big interest rate hikes that we saw, I think a lot of investors expected that we'd see a cooling off in terms of that demand. It had got to such a high point, and investors were kind of questioning as to whether that could grow any further, certainly as the kind of interest rates and inflationary environment started to bite on household consumer spending. And then inevitably, you know, when we see kind of macroeconomic volatility as well, that has a negative impact on consumer spend, and corporate travel budgets are often the first area that's cut or reduced. But certainly in this quarter's survey, the results are looking a lot more buoyant, as I say. So the general expectation is that corporate demand will recover and rebound over the course of the next 12 months, albeit coming from a lower base. But also there's a bit of an expectation that leisure demand may not be hit quite as hard as what investors were expecting when we asked them the same question in the previous quarter. So I think a lot of confidence there. We also ask around expectations of longer term accommodation demand growth within hospitality. And despite the IMF coming out and saying that, the medium to long term kind of growth globally is likely to be considerably slower than what we've seen historically, it doesn't seem to stop investors thinking that long-term accommodation demand growth is going to be very positive and somewhat buck the trend. And I think that probably speaks to that larger share of spending, for example, being moved across to leisure and experiences, which in turn will benefit travel and accommodation versus kind of spending on more tangible goods and stuff. So I think that's a pretty positive story to tell. Just in terms of the more kind of investment piece, we ask where investors are going to focus more of their attention going forward, which comes to the second part of the question you asked. And given that the expectation is around growth in leisure and corporate demand, unsurprisingly, there's going to be more of an investment focus on full service hotels. Historically, over the last few quarters, a lot of investors have been focusing more on limited service hotels because they're less exposed to some of the operational cost pressures and inflationary headwinds. And clearly, when times are difficult, you tend to see demand trading down as well, which benefits limited service hotels. But now the expectation around demand growth is more positive. I think the inflationary environment is starting to cool a little bit. Hopefully that will feed through supply chains and into hotel operations. So investors definitely starting to focus more on full service properties relative to where they were kind of in the previous 2 quarters. So that's pretty exciting as well. A lot of investors had, as you would expect, taken to the sidelines through the latter half of 2022, given all of the macro volatility, but they're now starting to come back into the marketplace again. I think it's becoming easier to underwrite, given that we've got a bit more certainty on what the future now looks like. That macroeconomic stability certainly starting to feed into investor positivity around engaging or re-engaging with the marketplace. So that's great. And that increased competition means more demand for stock, albeit, a shortage of stock continues to be a bit of an issue. But clearly, if there's greater demand, that will support keener pricing. And if there's keener pricing, you get that narrowing of the bid-ask spread, hopefully. And therefore, as kind of seller and buyer expectations become more aligned, hopefully that will result in an increase in deal flow as we move through this year. So that's what all of the signals are pointing to. I would also say that, and this has been a common theme across the last 3 quarters now, but definitely a shortage of traditional hotel stock on the market and hotel investment opportunities has displaced a degree of capital into some of those hospitality subsectors. So you mentioned co-living at the top of the call, but service departments as well. Clearly, it's a model that's proven to be incredibly resilient through the pandemic and come out very strong. So that's capturing the attention of a lot of investors. And similarly, hostels. I mean, a lot of people wrote hostels off through the pandemic, but certainly a model again that's coming back incredibly strong, and is a great kind of attention as far as investment is concerned once again. So a lot of positive news there too.
And Joe, if you were to put your analytical head on here, with those survey results, and perhaps also the lively conversation that you were talking about with those investors after those results come through, what conclusions would you draw regarding future investment activity just for this year?
Well, as I say, I'm pretty hopeful, and I think a lot of the brokerage community, and Rachel can talk to this better than I can, albeit I used to be at CBRE for a number of years. But I'm sure a lot of the brokers will be hoping in particular that, and the buyers for that matter, that are sat on considerable amounts of capital waiting to be deployed, they're hopeful that there's going to be an increase in liquidity and deal flow and more assets coming to the market. I think, coming out of the pandemic, there was the expectation from a buyer's point of view that there were going to be significant write-downs in value, and therefore an opportunity to acquire hospitality investment opportunities at a pretty low price. But so far there hasn't been a great deal that's pushed sellers to put stock on the market, despite the fact we've seen a big increase in interest rates, cost of debt. And I'm sure that as that flushes through refinancing, we may see a little bit more of the market, shall we say. But I do think if we see more competition to acquire, that in turn drives higher pricing. The fact that people can be more confident around future cash flows, certainly if the expectation is that we'll see a little bit less pressure through the P&L, so hopefully profits will increase and also will be supported by increasing demand levels. And all of that hopefully will lead to a more buoyant transaction taking place.
Thanks, Joe. Thanks a lot. Rachel, I'd like to bring you into the conversation here as our perspective from the United States. I mean, what's the latest forecasts from CBRE?
So firstly, I'd like to add also, I'd love to hear from Love on his perspective on the office, just since he did say that I think he's in the office business as well. From our perspective, the flexibility and remote work is definitely driving increased capacity utilization in leisure. And we think that is a key reason that leisure can remain strong. I'm not sure if Joe saw that in his survey, but with respect to our forecast, we're looking for just north of 6% RevPAR growth in 2023 on average. Of course, investors don't invest on average. So we do provide market and submarket forecasts as well as price tiers when people do drill down and invest their capital. But we are expecting, unfortunately, Joe, the margin compression to continue. So in terms of NOI per key, we're only looking at 4% growth this year. That would still be all-time peak profitability. And we are seeing strong interest in the segment. I mean, if you look at Blackstone that just raised whatever, 30.5 or 30.4 billion, citing alternatives in hospitality as a key area of focus. Hotels is one of the only asset classes within the broader real estate where you can still earn, or the yields are above the cost of financing and above the cost of capital. And with these strong demand trends, particularly in leisure and in group, driven by what we see as the flexibility in office and the fact that now all 7 days of the week can be fair game, whereas it used to be Tuesday to Thursday was peak occupancy or Monday to Wednesday, depending on what market you were in. Now every day of the week has an opportunity to fill and to drive rate. So we really see those as key drivers and a reason to remain bullish on traditional lodging. And then, as Joe said, we are seeing traditional lodging companies sort of blend into other asset subclasses and maybe Love, who does co-living and flex living and office and hospitality. I'm sure you'd have some to add on that.
Sure. Yeah, I think, look, I agree with not to be the, let's say, cold water on the conversation, but maybe also just to provide a different perspective. I do agree with both of your positivity on top line in terms of hospitality. I do think there's a lot of drivers for continued revenue growth on the leisure side, even though people are concerned about cooling. I'm optimistic about China and Asian travel opening up. So depending where you are in the rate structure, that could be really beneficial and what type of leisure you target. And historically, I'm always kind of, I'd say, barbell bullish, let's say, economy select service to luxury, that middle of the spectrum that relied on a lot of business travel historically. And I have a couple of those assets in my portfolio. Those have still, I mean, each of those are in specific markets with specific issues, but those have lagged, I believe. And I am hopeful that business travel returns, but and optimistic, but I do think that internal business trips will be fewer. So I'm not sure how that will play out. If I was to be most bullish, it would again be on the ends. And then if we translate that into the bottom line, I think, and again, this will probably hit the lower rate properties than the higher rate more. I am concerned about the increased cost of labor. And now all the brands are making us as operators, make rooms every day. They're all pushing PIPs again. They're all concerned about rate parity again, whereas they forgot about that for a couple of years. There was a number of things on the operational side that I do think are starting to come to bear on the P&Ls. So that's, let's say, what worries me going forward. I agree with you that 2022 for my leisure properties was a record year, both on top and bottom line for the most cases. But I'm concerned about that cost creep, maybe eating into some of the future growth, and in certain properties even reducing NOI. And office demand is very it's a very specific strategy we're going after. And I think, unfortunately, overall office demand, I think, will be lower. I mean, I focus mostly from an office perspective on New York City and London. And what you're seeing in both markets is a flight to quality. So if you can consider an office best in class, which is pretty much 6 elements, I would say a ESG focus, which is very important to tenants and investors, end of trip facilities, COVID compliant HVAC, hotelized services, smart building technology, and outdoor areas. These buildings will fill up and you'll get very good rents. Employers want people to come back to the office for the most part and want to create an inviting environment for them to do so. Those assets that can't meet those are the ones that will bear the brunt of the reduced demand. And so I think from a business travel perspective, as I said, I do think we will see a muted to longer recovery. And maybe it's important to actually buy hotels near those best-in-class offices. Maybe it's another consideration when making an investment decision.
Mm-hmm. Love,
Rachel,
actually.
Sorry, I was just going to ask Rachel briefly. You mentioned the kind of erosion of revenue falling through to the bottom line. And what is it in the US that's driving that in particular? Love mentioned the payroll issue, and clearly, I think there's actually a lot of hotels now that are almost adapting to the new normal, right, and finding ways to operate a hotel, but on much leaner or skinnier kind of staffing model. And actually, in some cases, that's supporting increased profitability year on year. But is it increasing payroll, Rachel, or is it energy costs which are also kind of biting this? What do you see in the US in terms of the biggest?
It's both, but it's also what Love said, which is that, margins were buoyed by the fact that amenities were closed and brand standards were not enforced. So 2 things are happening. Wages are up, right? We've seen hotel wages outpace national averages by 2-fold. They're still increasing 6 or 7% year over year, depending on what month it is. Plus, you're having to open these amenities, restaff. There's about 26 FTE openings per hotel in the United States currently, and that will lead to future wage gains. But also the revenues associated with the amenities, although they are cash flow accretive, they are margin dilutive, meaning your highest margin item in a hotel is your room. As you reopen your restaurants, you're getting, yes, incremental cash flow, incremental dollars, but it's going to compress your margins. And so that's why you don't see the flow through necessarily from RevPAR to NOI per key.
Interesting.
I was going to ask Love, as you were talking about certain factors that are, what's influencing your investment decisions. Would you be able to talk about how that differs between the US and the UK, or would you say that, for example, labor challenges are very much present in both markets?
Yeah, I mean, labor definitely is an issue, I think, in both places. But I think when we look at an investment, of course, there is all the individual to each deal, supply, demand, competition, asset positioning amongst the comp set kind of analysis we do. But to speak to maybe the more broader issues, let's say, affecting both markets, I think the most important ones when we're thinking about investments these days are inflation and interest rate in one bucket, and in another bucket is, cap rate versus rent or rate growth, right? Because that higher interest rate potentially driving higher cap rate depending on your exit timing or whether you're holding versus selling upon stabilization. I think, and that actually, the first element I think is the real big difference I see between the US and the UK is, US you're down at 5% now in terms of inflation, and the UK is still stuck at 10, which is, really a concerning factor for me as we differentiate between the two economies. To give a little ray of hope, and this was more in the context of office investment, we did a lot of historical analysis of how the Bank of England base rate moved in times of higher inflation. And it wasn't when probably any of us were working, but there were a number of times in the past where inflation went up dramatically and interest rates were pushed up to mitigate that inflation rate increase. And, as always, economists at that point predict this kind of slow curve down. In reality, in almost all cases, within 8 quarters, the BOE base rate was back down at the just prior historical average. Now, I'm not saying that we'll get down to 0.5 point. I think that was uniquely low, but if I want to be a little optimistic, I do think once we start to see inflation materially mitigate, and we're starting to see that in the US a little bit, there's maybe one more rate increase planned, and then who knows, maybe cuts by the end of the year. I do think you will start to see more optimism from buyers as to what their exit caps will be, even before interest rates come down. Just the inflation mitigation will start to bring that into the analysis as I will do, and I think that will help buoy investment activity and people's and investors' outlook on deals. At the moment, because we fund our deals with our own capital plus deal by deal investment from co-investors, many investors are very concerned about exit cap, and I'm probably the most bullish on rates coming down. Another factor that I think is unique difference between the two market on that aspect is people's home mortgages. So in the US, a lot of people are on 30-year fixed rate mortgages. In the UK, that as a product doesn't exist, right? So most people who own homes are extremely affected by these higher rates. And if you see inflation come down and people have been paying these very high mortgage costs for 2 years, I think there will be a lot of public pressure in the UK to cut the rate quickly. And so, I'm optimistic that these interest rates are going to drive a lot of people into a problem. Not that I'm optimistic about that, but optimistic that will force a change to a more normalized level of interest. And so, yeah, that's I think the main difference between the two. When I think about asset classes, because I think that was another relevant aspect here, I do think actually living and hospitality are some of the lowest risk asset classes at the moment and most popular asset classes, especially because of the widely publicized link between, let's say, NOI growth and inflation. Hotels having a one-night lease, you can adjust them per interest rates, etc. But that has actually made it like near impossible for buyers in the current environment to buy multifamily or for rent housing and hotels at a level that you feel good about. And I think that's obviously driven this low transaction volume. So we've actually tried to focus our investment approach a little differently as a result. That's why I mentioned office. Most people are scared of office, but you can, if you understand how tenants are moving and focusing on best in class, there is an opportunity there. Otherwise, within the living and within the living spaces, in particular, in that spectrum between hotel and living, co-living is an area that we've started focusing on a lot. Interestingly, some investors consider it, as a very, very established asset class now, which is a change if you rewind, let's say, 3 to 5 years ago. Investors are suggesting me to look at assets with a C1 permission as co-living rather than service department. Before it was always me saying that. Now they're actually telling me that. And so it's interesting how accepted the asset class has become, even after what happened to the collective, right? So it's interesting. There's so many operators now and such an optimistic outlook, and I think that is driven by the higher energy costs. And I think there's a unique window in time here before councils catch up on planning, where you can make co-living business plans work on C1 permissions where you haven't had to build affordable. Maybe that's a controversial thing to say, but it's the reality at the moment, and that may not last forever. And then the other way is we're looking at doing more pref equity type of deals in multifamily, like for example, where some of my investors don't want to take the last dollar risk. There are other sponsors who are willing to take that. Maybe on larger transactions, we can do a pref or a junior pref piece of equity. And therefore they're willing, or some of our investors are willing to take a lower return for a mitigated risk when, you can debate cap rates for years at this point. Yeah.
Can I just ask, because I don't know the Bank of England that well, despite being 100 and a trained economist, this sort of gap down or correction in the base interest rates, what type of recession did that come with? Like,
oh yeah, that's very true.
I always worry, is that where we want to go?
Yeah, it's a very good point. And yeah, I think it's largely because it did every time drive the steep interest rate increase did drive the economy into a recession. So that definitely was the reason for that. And I think there will be pain before, especially with the inflation so sticky at 10%, it's hard to see how there won't be some impacts for, the broader economy, and probably focused in specific areas. But yeah, that's why the rates were eventually cut again, right? Because there was actually hurt in there. Yeah. Whereas in the US, do you think that because the rates are coming down, so inflation's already coming down, that perhaps then you avoid, I think that's the general view now, right? You can avoid a recession and have more of a soft downturn or landing?
CBRE is calling for one more rate increase, as you said, and definitely weakness in GDP declines in the back half of this year. For hospitality, we always debate, like, okay, if we're going to have negative GDP isolated to the late third or fourth quarter, how much does that impact 2023? The answer is probably not very much. The question is, how severe is that downside, and how quickly is that recovery in 2024? Because if you told me that I was going to have some softness around Thanksgiving or the first few weeks of December, I would say that doesn't really matter. And I think for that Christmas, New Year's period, that trip was booked a year ago. So I'm less worried about that. And it accounts for such a large portion of the overall business in the fourth quarter. That it's debatable about the impact that it will have on next year. That said, if it is a material recession or it does endure, of course, lodging is cyclical. I was also just going to follow up on the point that you made about doing deals that people feel good about. And I wonder at what point people begin to just have FOMO. And they're less worried about a deal that they feel good about. They just have so much capital that they have to deploy if they want to continue to earn their fees. That hotels still, again, front and center looks pretty good from a yield basis.
Yeah, I think that's right.
Do a deal, whether or not, you're...
Yeah, you may be under pressure to invest. So much money has been raised, in particular for hospitality, and so many new entrants into the industry. That is the wall of capital is for sure a consideration. I think as we get into the next topics too, I think we've been talking more about the investor demand side. I do think there are elements that will also push down, in certain cases, seller expectation or seller pricing, in particular, as we get to a lot more refinancing events, and that can help bridge that gap too. And maybe there is a world where both parties, or maybe it's the buyer being happy and the seller being unhappy, which so far has been the other way, I think.
A comment from the audience, back to what we were talking about just a little earlier. We have had no recession here in the UK, and all stats show this. So just wanted to flag that one before we move on. A moment ago, we were talking about banks And I know the banking situation has certainly been up in the air, or thrown up in the air over the last month or so. And Joe, I'd like to bring you in here to talk about Europe, focus on the US. We've talked a little bit about the UK. But what impact do you think that the recent banking turmoil will have on investor confidence in Europe?
Yeah, good question. Quite a broad one as well. You know, I think just kind of speaking very generally, clearly the cost of finance has gone up significantly. We also saw a lot of lenders kind of step back from the market as well, particularly kind of, you know, your kind of typical clearing banks and what have you that have typically been quite active in the sector, but took a step back, and a lot more kind of debt funds coming forward, looking to provide finance, but clearly at a kind of much more costly level. Now, I think a lot of the transactions that you've seen take place, or certainly a number of the investors that have spoken about their activity where they've acquired over the course of the last kind of 12 months, if you like, most of those deals have been structured on an all equity basis, and then, you know, they're looking at some point down the line to kind of refinance and call on lenders. So you know, I think that's really driven, or been the driving factor behind a lot of investment funds that have acquired more recently. But then, you know, not every investor has the capability to be able to go in all equity, right? So that probably means that many investors as a result have had to sit on the sideline as well. And if you don't have the same level of demand in the marketplace, then clearly, you know, that demand isn't there to drive up pricing. So that's certainly been having an impact as well. I do think that, you know, if you look back at transaction volumes, inevitably about 5 years ago was a high point around deal activity. So there are going to be, if you're working on a 5-yearly basis, there's probably going to be a lot of refinancings this year. There will be some owners that don't have appetite to put any more equity in if all they can get is finance at a lower LTV, for example, or if values have come off. So that's going to probably create some fairly kind of sticky situations, and it will either spin out in sales or whatever else. So, you know, inevitably it will have an impact on the level of liquidity in the market as well going forward. But so far, kind of speaking to the different agents, and, you know, Rachel, love chime in here, but it doesn't seem like there's any real distress in the market. Yes, maybe a few kind of stressed situations, but no real distress as of yet.
Yeah, it's been pretty limited. And I think what we learned after 9/11 and in the global financial crisis is that banks realize it's really difficult to operate a hotel, particularly a full service hotel. And so if there's a way they can bridge that gap, even if it's just on a temporary basis, they're willing to do it, because for them to step in, presumably, if somebody's going to give back the keys, it's not making the cash flow that the investor wants to support that debt financing. So if the bank's going to take it on balance sheet itself, and it's going to be underwater, and it's going to be hard to operate, and they're going to have to write it down, they're unlikely to do that in our view. It's not that it won't happen, but it will happen in a more select, you know, one-off basis than it would possibly in another asset class where the lease terms, you know, 5, 10, 30 years.
Yeah, I mean,
Go on, Love.
I think as we look at also not just the UK perspective, but also the US perspective, I think the first first impact for me was that I actually had an account at Signature Bank that day, so I had to really rush to move the money, though the account is still open and fine. You know, we felt uncomfortable leaving funds in Signature Bank, and I mean, overall, I'm not concerned that there's, I don't know if that's anyone's question, that there's some sort of banking crisis coming as a result of the failures we've seen. I mean, I think there were specific issues, you know, a specific depositor base in terms of SVP, and I know Signature Bank did have a lot of actually activity in the crypto area as well, and Credit Suisse has been having a long history of issues, and I do think banks in general have been lending much more conservatively since the GFC. So I don't foresee some sort of banking crisis and deluge of problems and then transactions as a result. But I do think there's a nuanced impact of what's occurred, and I even saw it in the days after those bank failures, where some of our existing lenders sent us a lot of questions, started reviewing the performance, wanted to see how the regulators were asking them questions. And so I do think at the time of refinancing, I don't think you'll get as good deals out of the regional or larger banks or whoever your lender might be. And that can create an opportunity in two ways. Either it will force a sale. At that point, I agree with you, Rachel. Banks don't want those back. I think they'll end up trying to amicably sell or find another solution. Or there will be opportunities for alternative lenders to come and fill that gap. And the investors we work with have both arrows in their quiver to be able to buy the equity or provide a mezz or a pref equity piece. And I think those opportunities will start coming in as we get later in the year, because I do think those banks, the loan origination officers' hands will be tied to some extent when doing that refinancing. So I think that's mostly the impact for me.
Mm-hmm. Just last week, I held a webinar on behalf of Boutique Hotel News, and the title of this webinar was called "More Stressed Owners, More Distressed Assets?" ? So we debated whether we will see distress on the market, and there was quite a lively debate. It's worth going back and watching the recording between two of my panelists about whether banks will foreclose or not. Someone saying, absolutely, yes, this is going to happen. Someone else saying, no, there's no way, it's not going to be anywhere near as bad as what we've seen before. So for those interested, we'll pop the recording into the chat for you, because it's certainly one to watch in your spare time. Joe, with everything that we've been discussing, where do you see the opportunities in hospitality and operational real estate?
Oh, good question. Yeah. I think kind of Love referred to it earlier. It's very hard to kind of discuss this in more general terms, because I think the opportunity actually set level. So we touched on kind of the nature of office demand and how there are some offices that will continue to perform very well because they're well located and cater very well to their occupiers' needs. And I think for hotels that couldn't apply kind of more, to be honest. And the same for hospitality. I mean, it goes back to kind of location, being relevant for your target market. I do think where some of the opportunity exists is where there has been a fundamental shift in the nature of demand. So we talk more broadly again about kind of leisure and corporate demand, but more specifically, what are the kind of segments within leisure demand that are really firing or not, as the case may be, and the same in corporate, which are the business sectors which are performing very well and are likely to going forward and have a need for accommodation versus those that don't. So, you look at kind of corporate accommodation demand, and yes, the quantity of business trips has maybe fallen off, but it might be kind of fewer but longer and more purposeful business trips, for example. And if they're going to be longer business trips, then does that play into the hands of the service departments, for example, and the longer stay model? Question mark. But I think, though that's where the opportunity exists. I also think that, again, kind of speaking to the survey and the investor council meetings that we have, there's a lot of investors that feel that there is a real material asset management opportunity out there, not just to reconfigure hotels for the way that demand has shifted through the pandemic, but also just because a lot of hotels have been relatively neglected for 2 or 3 years now. They've been starved of capex because there's been no cash flow, so owners haven't been able to deploy capex. So there's a lot of hotels and hospitality stock that is a little bit worse for wear, if you like, and I think therein lies an opportunity as well. There's no doubt that travel demand has changed considerably over the last 24 months, and it's about how you can reposition your asset to capture that next phase of growth and those segments that are going to drive that growth.
Mm-hmm. I'd like to come in with a question here from the audience. If I don't ask it now, I'm worried that we may not have time, as I've got some closing questions for Rachel and Love here. But when will there be a place for opportunistic private equity groups to get involved again? Joe, I might fire this one over to you as, again, broadly talking about hospitality and operational real estate.
I mean, I think the private equity groups to a degree are already involved. There's quite a number which have been pretty acquisitive fairly recently. And yes, it's not the large portfolios that a lot of these big institutional investors would love to deploy very large sums of capital into. It's more kind of one-off transactions, but we're seeing them certainly in Southern Europe. I mean, there's been a number in Italy. And again, I think it's kind of a repositioning opportunity. It's an asset management opportunity. That's where they're now seeing angles to deploy capital and make a return. You know, it's acquiring well-known big independent hotels, and there's an opportunity to flag them or reflag them, and think about kind of capex programs, as I say, to make sure again that they're capturing that new era and that new type of demand that's coming through as we move forward, and therein I think lies the opportunity for private equity. Rachel, love, do you have anything to add to that?
I was just going to say, I'm not sure if opportunistic is a euphemism for purchasing distressed assets, but I would first, wonder, why is the asset distressed? Two, as Joe pointed out, what is the deferred capex in that asset? And I think, as both Joe and Love have pointed out, what does the trajectory of that recovery look like? Because if you're going into a distressed asset with deferred capex and you're on a 5 or 7 or 10-year cycle, but you have a big capital outlay to begin with, and then you've got 2 or 3 years of recovery or stabilization, that's when you make most of your money. So it would need to be somebody very well funded, in it for the long haul, and with strong conviction that even though it's impaired currently, there is a path, not just from the exit multiple, but from a cash flow standpoint, to get back to an appropriate return. I think those opportunities do exist, but I do not think there are a tremendous number of them. I do not think this is the global financial crisis or 9/11. And as I said earlier, I think what we learned from those two is that most banks don't want to take back. They don't want to force a sale. If they see a direct path to profitability, they'd rather take the straightest line.
Yeah, and I'm historically an opportunistic investor before being an operating partner, and most of my investors are that. And I think the question is coming from most of what you're describing, Joe. I think the person asking the question probably thinks is more of a value add business plan, probably targeting a mid-teens IRR. And I think when they're saying opportunistic, they probably mean like around 20 or above 20 equity IRR, which is very hard to make pencil under reasonable assumptions these days. I would say I would say that only comes, as you rightly said, Rachel, on very specific cases. And I think we'll have to wait for those opportunities where there is a refinancing event. I don't see any other reason why that will occur. Like if and this is something we're also looking into, we should be tracking very large loan maturities. You should be looking at TREP. If you're in the US, you should be looking at how to find those large maturities coming up. And in order to make those 20s, I believe you will have to combine that with a value add business plan. I don't think in any good location you can just, nick an asset. It's going to be a combination of buying it well due to some seller motivation, as I said, most likely on the debt side. I don't really see any other reason, and combine that with spending money on the asset, rebranding the asset, changing how it operates, these kind of business plans. I mean, and I think one way you'll make it opportunistic, I agree that lender may not want to take it back, but they may offer you pretty good terms to not take a hit on their loan in some cases. So for example, we bought an asset last year in New York City where we assumed an in-place non-recourse securitized financing, which effectively amounted to 90% LTC and then 80 after I spent the PIP, and I was willing to spend the PIP at 4.5 for 4 years. That's pretty amazing in the current environment. And maybe that's a way, and that's how we made what would have been a value add return into an opportunistic return. But that was one deal after looking at 1.5 billion.
And that
of
was
hotels.
also, I don't know when it was last year, but that was last year, right? We've
Yeah.
had a big increase this year. And I would also say another complicating factor, which you did mention, is an opportunity to just swap the brand. Those in and of themselves, if you're dealing with a larger full service asset and a major or globally recognized brand, those are few and far between.
Yep.
And then in many cases, if it is a recognized asset, you'll be competing with the REITs that have not drawn down on their credit facilities. They have good cash flow. Their cost of capital is not high. And we have seen rebounds in their valuations as well. So those deals do exist, and congrats to you, Love. I'm just saying, I don't think it's a broad sweeping
Agreed.
cleansing of the asset base, so to speak.
Yeah. And by nature, when you say opportunistic investor, it's something different. It's a specific opportunity, hence why I'm looking where places in sectors others fear to tread, right? Like you're taking more risk for hopefully more return. And that's why looking at office or new sectors like co-living, I think those could be good places for opportunistic investors to trend towards.
Rachel, I'd like to, we're fast approaching our allotted hour, but I'd like to ask you this question, please. I'm going to do my best to try and tie it together. We've discussed how a shift in investor sentiment is now broadening, and Love's a great example, looking at office, co-living, multifamily, etc. What impact will that shift have on hotel growth? And do you think that as a result of that, we will likely see the hospitality and living sectors converge at a greater pace?
Well, I think we're already seeing it, right? And this maybe particularly focuses on the US, but we're what we might consider a mature industry. And we've seen, for example, the number of brands more than double in the last 20 years. I think if you look at the big public operators, some of them have over 30 brands, which means that they're sort of niching down into a smaller and smaller segment. And the name of the game for them is to grow their total addressable market and increase their loyalty base, which of course helps lower customer acquisition costs. So we've seen all sorts of strategic alliances, growth in price points. You can think of Marriott working with Vacasa, or One Fine Stay, right, moving into short-term rentals. You've seen Hilton move into True, which is a lower price point, right, upper mid-scale, trying to attract a new customer base. We saw an announcement out of Hyatt, I believe it was last week, also, right, Hyatt Studios also going into a lower price point. We've seen all of the major US brands enter the all-inclusive space, really for the first time in a substantive way as a way to capture that leisure business. And we're seeing a convergence in extended stay hospitality with traditional apartments, brands like WaterWalk, where you can rent a furnished apartment or you could go on an extended stay basis. And then, as Joe mentioned earlier, the hostels, so the convergence of co-working, co-living hostels in the Salinas of the world, or at a higher price point, Hoxton, for example, Ritz-Carlton going into cruise lines, almost every luxury development having branded residential. I think really the way to grow your total footprint or your total addressable market is to attract new customers or your same customers in a new need state where you didn't have them before. And I expect that to continue given how strongly penetrated the US hotel market, traditional market already is. Does that match everyone's thinking?
Indeed, yes.
It's
Absolutely
what we're seeing. Anyway, if we are finished up here, I was going to say, Love or Joe, if there's anything you would like to add, now is your time to shine.
Yeah, no, I think that was really fruitful discussion, and thank you, Eloise, Rachel, and Joe for speaking with us.
Thank you so much, guys. Let me wrap up this webinar. I've just got a couple of closing slides to show you before we must all dart off and continue with our busy days ahead. But If you are interested in learning more about the purpose-built student accommodation sector, my colleague George Sell is hosting a webinar on the 10th of May at 2 o'clock UK time, and he's going to focus on the student accommodation market in the UK and Europe, going to be covering such things such as an investment, finance, sustainability, flexible living, and more. So the link to register for that webinar has been popped into the chat. And as we are talking about the convergence of asset classes, the Urban Living Festival is taking place on the 5th and 6th of July this year at East Winter Garden in Canary Wharf. And further information about ULF has been popped into the chat if you would like to learn more. And if you're interested in working with us, please get in touch with either of my colleagues, Katie or Steph. Their details have been popped up on your screens there, and I believe their details have also been popped into the chat for you to follow up with. All that's left for me to do today is to say thank you. Thank you to Rachel, thank you to Joe, thank you to Love for all your insights and contributions today. We're going to leave this webinar open for an extra 2 minutes for our audience members to follow up with anything that we've popped into the chat. Otherwise, I will see you all very soon. Thanks a lot for tuning in and take care, folks. Bye-bye.